Good morning, class.
Good
Good
morning,
morning.
sir.
Good morning,
Good
sir.
morning, sir.
Okay, we have 18 people in class. I think we can start. It is, according to my time, 6:40. How is your morning? I hope you were able to read few things about what we did yesterday. Were you able to go over what we did yesterday?
Sir, no.
Nah, not me. I'll do that
Okay,
during the
so
weekend.
when are you going to be reading over? You see, the more you delay the reading over, the more you can lose what you have gotten.
I will do it.
This morning, we are supposed to continue our lecture on cost volume profit analysis. We introduced the topic yesterday, and we decided to do something briefly on marginal costing because we'll need some of the principles in there to help us understand cost volume profit analysis. So we did that, and I was expecting that by now you would have gone over the marginal costing concept to have it solid before we progress. Before I forget, I told the book producer to make 20 copies of the books for me, because if I look at the numbers, the class is about 60, a little over 60, so I'm taking it like 60. And with the copies I gave to Raymond and the few ones I kept here, I think we'll be short by around 20 thereabout. I didn't have the intention of producing and storing the book because the book is under revision, is under construction. So any unsold copies will just be waste of money. So when I go and make the 20 copies, it means that all of you should do well to get a copy. Otherwise, you will make me go into losses unnecessarily. I just spoke with the producer yesterday, so that's an information for you. Let's try to
Yes.
do a recap briefly on what we're trying to do about marginal costing yesterday before we start full work on cost volume profit analysis. But before that, I don't think you even have questions because you never read. Before that, let me ask, any question on what we did yesterday? Or just any question at all? Okay, no question. So we said yesterday under marginal costing that marginal costing concentrates mainly on variable costs. And at this level, when we are given some data on production and sales of a product, we should be able to identify all the costs that are variable in relation to the activity we are discussing. The activity could be production, it can be anything. So whether a cost is variable or not is always assessed in relation to the activity in question. And my experience is that most students get it wrong because they do the assessment with no regard to the activity in question. If you do that, you are most likely to get it wrong. You always have to access variability with respect to the activity in question. So if you are doing production of goods, then variability or variable cost is assessed in relation to the production of those goods and nothing else. If it is about running of a department, like our department or our school, then variable cost is assessed in relation to the running of the school and not something else. Okay. So it's your job to be able to identify in a given context what is a variable cost and what is not a variable cost. The opposite of a variable cost is fixed cost. Okay, that is not a problem. We also talked about the concept of contribution. In variable costing, because we think variable costs are the most important costs to consider in decision making, we compute our first profit level by subtracting all variable costs from sales revenue. That profit we get is not called gross profit, if you remember what we have done so far. The main template for preparing financial statement, after subtracting your immediate cost from your revenue, you get what is called gross profit. That layout uses absorption costing methodology. In marginal costing, we don't use that format. Marginal costing calculates its equivalent gross profit by subtracting only the variable cost. It means that in absorption costing, what we call gross profit has some element of fixed cost inside the cost of sale. We are not at this point in time interested in comparing marginal costing with absorption costing, but I just said that for you to be clear with certain things. So when you subtract only variable cost from your sales revenue, you get a profit called contribution. And I explained that the term contribution merely means that it's a contribution towards the recovery of your fixed cost, because fixed cost is never touched. We are now going to deal with fixed cost. So these concepts are key to what we are coming to do today, cost volume profit analysis. I hope to finish the concept in the first part, that is the single product environment. So what we are discussing now is for single product environment. The assumption is that the organization produces a single product. And of course, you can get some organizations into that kind of business. If time permits, at your level, we have to do the multiple products. But maybe not today. If you're able to finish, we will introduce it. So we are going to look at it in those levels. Let's start the business. We said that cost volume profit analysis tries to look at the relationship between the cost of the product, the volume, how much you have to sell of it, and how much profit will come out. That's the relationship. That's why it's cost volume profit analysis. Because when we go into business, we want to know that with given cost structure and with a given expected sales per unit, if you want some target profit, if you want some profit, what volume? You see, the cost structure is fixed and the revenue we will get is fixed. With that fixed information, what volume can we sell to get certain levels of profit? We first start the analysis with looking at zero profit. Zero profit. And that is what is referred to as the break-even point of the organization. Break-even point of the organization. With a given cost structure, or with a given cost of production, and a given selling price, how many should the organization sell? Or how many can the organization sell to break even, to get profit zero? Meaning to pay all of its costs, including fixed costs, but nothing left for maybe retained profits, nothing left for saving. We're able to pay everybody. Managing director is paid. All the other workers are paid. Our electricity bills are paid. Everything else is paid for. But we have nothing left. So we have broken even. We start the analysis from that level. But all organizations do not have the objective of breaking even. We have the objective of making some supernormal profit, as the economists say. Some target profit. So after looking at the break-even situation of the organization, we'll extend the analysis to what volume should the organization produce and sell if it wants to get some level of profit. Not zero profit, but let's say 1,000 Ghana cedis profit, 2,000, 1 million Ghana cedis profit. We should be able to use these tools to assess and work hard towards that. We will look at these two things I have said so far, ignoring taxation. But we do know that the government comes into what we are doing as businesses and takes something from us. So after what I have said, now we'll extend the analysis to where the government comes into the equation. So we'll look at, if we want to get a certain level of profit after tax, what volume should we produce and sell? You also look at that. Basically, these are the things we'll be looking at. We'll also be talking about the concept of margin of safety. And that will be done with the single product environment. We will do similar things. The methodology is the same, except that this time around, it is not a single product. So after a single product environment, we will use the same principles to look at multiple product situation. So that is the overview of what is expected of us with this topic. The reference book is the textbook that I just spoke about, that everybody needs to get a copy. The reference page is page 10, but you also have to read page 9 for the marginal costing principles. Okay, let's go ahead. We understand that from what we have done specifically on preparation of financial statements, the income statement to be specific, we understand that profits, or let's say operating profit, is equal to all the sales revenue we generate minus our total cost. Everybody should be okay with this. That's what we did when we were trying to calculate, we're trying to prepare the income statement. We said revenue. Then initially we looked at all the immediate costs to get our gross profit. Then we came to subtract all other costs called operating costs. Then we got what is called operating profit. Then we looked at interest and tax. Then we got our final profit. Basically speaking, that statement is underpinned by this simple formula. Profit is equal to sales revenue minus total costs. So this is the same formula we are going to use. We said we are going to analyze the organization's profit situation with reference to some volume that we have to sell. So this is the equation that links what we are going to do. The break-even situation of the organization is where we say this profit is zero. If this profit is zero, what should this be? Or how much sales do we make to be able to pay all of our costs, total cost, so that we get profit 0. This one will be given. This cost structure will be given. We can't change how much we can produce it. We cannot change how much we will sell one product for. But we can change how much we can sell. We can decide to sell 3 pieces of the product, 5 pieces of the product, 100 pieces of the product, 1,000 pieces of the product, depending on how hard we work. So how many sales or how many units should we sell to be able to generate sales revenue to pay all of our costs and get profit 0? That's the idea that we are going to work with. Let's break this formula down and we'll be able to get all the formulas we need to do these assessments. At profit 0, okay, for now, let me even ignore the idea of profit being 0. Let me represent profit with PR. Profit is equal to, sales revenue can be broken down as selling price per unit times quantity sold. This one gives you the same thing as this, total sales revenue. Minus total cost can be broken down as variable costs plus fixed costs. So total variable cost, total fixed cost. We still can break things further. Profit can be expressed as selling price per unit times quantity minus total variable cost can be expressed as variable cost per unit times quantity sold, because they vary with respect to the quantity. Minus total fixed cost. If you don't understand anything, this is simple basic mathematics. If you don't understand anything, let me know. If I do this one into brackets, this plus is correct. If I remove the brackets, this has to be minus. In fact, this is what I'm saying. Profit is equal to your sales revenue minus your variable cost minus your total fixed cost. The first equation was saying that profit is equal to your sales revenue minus the addition of your total variable cost and total fixed cost. So it is the same as what I have written below. If you have any challenge, let me know. Profit is equal to selling price per unit times quantity. If you look at this,
please, the third equation, the y variable cost attached to the small y, the y stands for what?
It is u, not y. I'm using it to represent per unit. Selling price per unit. You see this u here. Selling price per unit. This is variable cost per unit. You have to follow what I'm saying. Variable cost per unit times the total quantity gives you total variable cost. So this total variable cost is rendered into 8 separate components as this. Total variable cost is equal to variable cost per unit times total quantity produced and sold. I hope that is okay. Okay. So,
yes.
Yeah. If we look at this, if you look at this one, there is something we can do about this. So rewriting this will be selling profit is equal to, we have quantity common to both expressions. Quantity is here, quantity is here. So we can bring quantity out and then we'll get selling price per unit minus variable cost per unit minus total fixed cost. Everybody should be okay with this. We are rewriting the same thing. We have not changed anything. We are just putting them in a different rendering to get exactly what we want to get. So this is factorization. Kill out selling price per unit minus variable cost per unit into bracket. When I expand this, I'll get the same thing as what is in the red box. Profit is equal to okay. At this point, our focus is on getting the quantity that we have to sell, that we have to produce and sell to get certain levels of profit given our cost structure. That is why we are trying to isolate the kill and then make kill the subject so that we get a formula that can give us the value for kill, the quantity to produce to get certain levels of profit. So we can make the term with the kill the subject of the equation, in which case it will become kill outside selling price per unit minus variable cost per unit is equal to, it is already at the right side of the equation, so we can maintain it there. PR is already at the left side. We are moving total fixed cost to that part, so it will be plus. When the minus sign crosses the equal sign, it changes from minus to positive. So we have plus total fixed cost. If you have any problem with what I've said, let me know. This is the same thing. We have just made the term with kill the subject of the equation. We have changed nothing about it. Okay, so now we can proceed to make Q the subject. Making Q the subject means divide here by selling price per unit minus variable cost per unit, and do the same thing here. Selling price per unit minus variable cost per unit. This one cancels this. And then we are left with Q is equal to profit plus total fixed cost divided by selling price per unit minus variable cost per unit. So this is a derived equation that makes us get the value of Q, the quantity to produce and sell, to get a certain level of profit. So if we are assessing the zero level of profit, we put 0 here. If we want some target profit, like say 1,000 Ghana cedis, we put 1,000 Ghana cedis here. We put Ghana 1,000 cedis in place of the PR, profit. And then we'll be able to get the quantity at any point in time for whatever profit we want to get. So this is a very useful formula that everybody should understand how we have derived it. The basis on which we have derived it, you already understand it. So follow through, just think a little critical about what we are doing. You'll be able to prove even this yourself. And if you can do the proving yourself, by no means you have to chew the formula. You understand the formula, so you don't have to chew it. Okay, and then you should notice something. The denominator of the formula. Who can tell me what it is referred to? And if the person gets it right, I'll give the person 2 marks. Show by hand, then I'll call you. The denominator, the one I have put
that
in
is
red rectangle.
selling price as units.
Raise your hand first. I have so many people with their mics on. Derek, your hand is up. Derek, I've given you the chance. Your hand is up, or I should give it to someone.
That's the contribution.
Contribution. That's correct. But be more specific to get the 2 marks. Otherwise, I'll give you 1 mark.
That's the contribution and also called the fixed cost.
No, you are spoiling it. The contribution you said is correct, but you can add something to it to make it more definitive. That is contribution per unit or unit contribution, because this is selling price per unit, this is variable cost per unit. So this is contribution at the unit level, which is called unit contribution or contribution per unit. So I'll give you 1 mark. Derek.
Okay, sir.
So you can write a formula simply as Q is equal to maybe a target profit plus total fixed cost divided by contribution per unit. Contribution per unit. Okay, so this is the generic formula. In fact, this is the formula, this formula, that everything will be revolved around. That's the formula that everything will be revolved around. Now, let's look at break-even. So, break-even quantity, we can write it as break-even quantity. Someone can also write it as Q, then he puts 0 here, maybe Q at profit 0. So it depends, and it is very useful for communication purposes, that if you are using certain symbols to denote something, you will add definitions. So you can say where Q0 is break-even quantity, where BEQ means break-even quantity. It's very useful to do those definitions if you are using some of these things. So break-even quantity is equal to, we said at break-even profit is what? 0. So when we put 0 here, it will be plus total fixed cost divided by selling price per unit minus variable cost per unit, also called unit contribution. 0 is nothing, so the formula reduces to break-even quantity is equal to total fixed cost divided by selling price per unit minus variable cost per unit. Who has a problem with this formula? I think nobody does. Nobody does have a problem. Or who has a question? Or comment, addition, something to make us understand it better. Who has anything to say? Okay, nobody has anything. My students are great. So this is the formula when you want to assess how many quantities of the product. So if you are dealing with tables, how many pieces of tables that the organization should sell to get profit 0, to break even. This is the formula. So this is break even quantity. In business, apart from the quantity, we are also very much interested in the monetary equivalent. Okay, we have to sell 100 tables, fine. But that 100 tables is in what money terms? Is what value? Is what, how much Ghana cedis? So apart from break-even quantity, we also want to know the break-even sales revenue. The break-even revenue. If you know the break-even quantity, how can you get the break-even sales or the break-even revenue? Question for 2 marks. Show your hand, I'll call you. Show your hand. If your hand is not up, I will not call you.
The question again.
Emmanuel, your hand is up. If we know the break-even quantity, how can we know the break-even revenue? Yes, Emmanuel, you have the floor.
Hello, sir. We multiply the selling price times the quantity.
Exactly. We know the quantities to sell to break even. Each quantity can be sold for a certain price. We multiply the quantity, the break-even quantity, by the selling price per unit, and that gives us the break-even sales revenue. We will later look at another shortcut formula to get the same thing without multiplying, without breaking it into two, getting the quantity first and multiplying it by the selling price per unit. When we get there, we will know that formula. So for now, this is the formula to get a break-even quantity. Let's look at the quantities first. We'll later look at the revenues. But at least briefly, we know how to get a revenue by multiplying the quantity by the selling price. We'll look at separate formulas that makes us get the revenue straight away without multiplying it by the quantity. Now, this is the quantity to produce. The quantity to produce to break even, to get profit zero. What if we want to get some target profit? Then the formula, this is the generic formula. On top, we just put whatever profit we want at the position of the PR. The first one we have done, we wanted profit zero, so we put 0 here. And then this becomes the formula to use to get that. If you have some target profit, let's represent target profit with TP. In that case, the quantity to get that target profit, and see how I'm writing it. It's not break even again. Break even is a specific term for profit zero. Now I want a quantity to get a target profit. That is why I also said you can write even the first one as K0. That is quantity to get profit zero. Or you can say quantity K profit is equal to 0. It depends on how you want to communicate. So profit, a quantity to get some target profit is equal to target profit plus total fixed cost divided by contribution per unit. Okay. And everybody should be okay with this formula as well. So if our target profit before tax is, let's say, 10,000, when we are calculating, it's 10,000 that we put here. That's the target profit. That's what it means. Just like we put 0 there. Any questions on this formula? Any questions, class? Or contribution? Okay, let's go on. At this point, I think we can take some example to clarify what we are doing. So let's write some simple example.
Hello, sir.
Yes, question.
Please, yes. The total fixed cost, is it the cost of producing the item?
Yes, the cost of producing the item.
And it's always fixed.
Yes, it's broken. It behaves in two ways. We have some costs that will increase or decrease if we are producing more or we are producing less. Like they move hand in hand with the activity level. If you are producing more, those costs are also increasing. If you are producing less, they are also increasing. An example is, if we use the table production, for example, the cost of wood. The more we produce tables, the more we incur the cost of woods. So the cost of wood is a variable cost in relation to production of tables. Some tables have some plastics and leathers. The more tables we produce, the more the cost of the leather we have to incur, the more the cost of those plastics and metals. So the cost of those leather and plastics and metals are variable costs in relation to the production of the tables. Are you okay? But there are some costs, whether we produce 1 million of the tables or we produce even 0,
Is the same.
they stay the same. Example is the rent you pay for the factory.
Okay.
The landlord, you can't go and negotiate with the landlord that landlord, oh, this period, every month I produce 100 pieces of tables. This season, because of COVID, most of my customers have folded up, so I was not able to even produce a single table. So please, reduce the rent from maybe 1,000 to 0 cedis. You can't go and do that. Your landlord will still take his money. The only decision you can make is that when your rent period is due, you can tell him that you don't need the place again. But as long as you continue to be there, you will pay the same amount within a given period of time. Yes, it's fixed.
Thank you.
So you have to understand that behavior of cost. So in a given question, when you are giving information, you should be able to assess, given the information, which of the cost is fixed in relation to the activity and which of them are variable. Then you'll be able to compile all of the fixed to get your total fixed cost. Then you use the variable cost to get your variable cost per unit, subtract it from your selling price per unit, get contribution per unit, and then the rest of the work is just formula. So if you take your time to understand what we are doing, solving questions like this is the most cheapest, because if you understand the formulas, you will get 100% of the marks. So that is it. Let's take a simple example. I'm trying to create example. Or you have an example. You should have your book with you. Let's go to your book. That is chapter 10. The first example. The first example. Let's use those examples as we are learning, because they are good. The example you can see in the book. I have projected it. You can also, open the same page from your book and follow along. Frankfurt Motors is the name of the company. Frankfurt Motors is a small car dealership in Kumasi. On average, the company sells a car for 27,000 Ghana cedis. So what is that telling you? That is the selling price per unit, all right? Selling price for one car on average. We understand that different cars are sold at different prices, but we are averaging all. This one is sold for 30,000, 40,000, 50,000. Others are sold for 10,000. Others can even be sold for 5,000. When we average all of them, one car is sold for 27,000. That's the information. Or because we are dealing with single product environment, the assumption can also be that the company deals in only one type of car. So if it is Toyota Corolla, it is Toyota Corolla. So they are sold at the same price, 27,000 per car, which it purchases from the manufacturer for 23,400. The 23,400 is what? It's the cost of the car. Is it a variable cost or fixed cost? Hello, I can't hear you. Variable cost or fixed cost?
The variable
It's a
cost.
variable cost.
Variable cost, good.
Variable cost, yes.
Okay, let's proceed. Each month, Frankfurt Motors pays 48,200 in rent and utilities, and 68,000 for salesperson salaries. So let's take them one by one. The rent for where he operates from and the utilities he pays for 48,200. Is it fixed or variable?
Fixed.
It's a fixed cost. Good.
Yes.
Then the 68,000 salesperson salaries. Is it fixed or variable?
It's variable.
Explain.
It's fixed.
It's fixed cost.
It's
It's
fixed,
fixed
it's
cost.
variable.
It's fixed cost.
Explain your position. Who says it's variable?
Sir, please explain.
Okay, now you said you think it's fixed then. You assess the salesperson salaries to the activity we are doing, selling of cars, dealing in cars. The people who help us in selling the cars within a given period, whether we sell one car, well, if we even don't sell cars, once they are on our payroll as our workers, whether we sell a car, whether we sell 10 cars, whether we sell 50 cars, we pay them the same amount as their salaries at the end of the period, at the end of the month. So it's fixed. It's a fixed cost. In addition to their salaries, salespeople are paid a commission of 600 Ghana cedis for each car they sell. Is that one a fixed cost or variable cost?
That is variable.
That's a variable cost. Good.
Variable cost.
Frankfurt Motors also spends 13,000 Ghana cedis each month for local advertisements. Is it a variable cost or fixed cost? Think about it, variable or fixed. And think about whether it is variable or
It's
fixed
variable.
in relation
variable.
to the activity we are talking about. Is it variable or fixed?
So it's variable.
What makes it variable? Explain.
Isn't it fixed?
So,
Oh, if I say
It can
explain,
be
doesn't
changed.
mean you are wrong.
so it can be changed. The cost for advertising can be changed at any time.
It's fixed.
Okay, Derek, you have your hand up. Derek,
This.
So I think that if we are breaking even, or if we are not producing anything, we are not going to advertise.
okay,
So producing a unit, then advertising is a variable cost.
fine. So you said if you are not producing anything, if production level of tables is 0, he thinks we will not do any advertisement. But what if you start production and you produce 1 table? Your advertisement level increases in response to the 1 table, right? And then you produce 2 tables. Advert also jumps from where it is to an equivalent 2 table. 5 tables, it also rises. Is that how advertisement cost behaves?
No, sir.
No, sir. It's a fixed cost.
It's a fixed cost. Largely, it's a fixed cost. And it is even true that some organizations start advertisement before they start production, just to create the awareness of the product. I remember before Glow came to Ghana, they did a lot of advertisement. They even sponsored Ghana Premier League. They did a lot of costs. They were all advertisement, publicity, long before they even started selling their chips and started business. And all of those costs they incurred, sponsoring Ghana Premier League, doing all those publicity were fixed costs. So advertisement is fixed. When you go and advertise, let's say the advertising media or medium takes you say 1,000 Ghana cedis. That 1,000 Ghana cedis is fixed for all the cars you will sell within a given period. The money is not, the cost you incur on advertisement does not respond to the number of cars you will sell. So that if you sell 1 car, its advertisement cost is different from when you sell 2 cars and 3 cars and 4 cars and 5 cars. No. I told you have to assess the variability or the fixedness of the cost in relation to the business, the activity we are discussing, selling of cars. When you go and do advertisement with, let's say, Adum TV, about the fact that you deal in cars and this is where your location is and the kind of cars you deal in, that cost you pay is fixed. Whether you will sell 3 cars, 4 cars, 5 cars, is the same amount you have paid. That's it. So it's fixed. Let's for now ignore the tax issues because we'll talk about the tax issue later. Now requirement A. How many cars must Frankfurt Motors sell each month to break even? So we are talking about the break even quantity. How many cars? And then you know the formula, right? You know the formula. Formula work is the cheapest work you can get. We said if you want to break even, it means we expect profits to be zero. We expect profits to be zero. Profit to be zero, and this is the underlying formula. Total fixed cost divided by unit contribution will give us the quantity of cars we have to sell to break even, to be able to pay all of the costs that we have said. So I want everybody to attempt applying the formula, and let's see what figure we will get. Let's do the sketching here. We have, let's try to calculate our total fixed cost. It's a combination of all the costs we itemize as fixed. So we have rent and utilities. Rent and utilities. Okay, let me go down so I can get space. So total fixed costs. Rent and utilities. What is the value?
48,200.
Okay, those with the book, please follow and help me so that I don't go back and forth. 42,000.
48,200.
48,200. We also have sales,
Salaries.
salesperson's salaries. What was the value?
68,000.
68,000. Then we had advertisements.
Yes.
Advertisement cost. What was it? 13,000.
13,000.
So these were all the fixed costs. Let's add them.
129,200.
129,200.
200.
Okay. In the textbooks, there were a few typing mistakes. So you have to be guided by what we are doing. That's why we are making the revisions. So 129,200, 129,200 Ghana cedis. This is our total fixed cost. The variable cost was only one, right? That's the amount so let's do selling price per unit of car was 27,000 Ghana cedis. Variable cost per unit, that is the cost of buying one car, was
23,400.
23,400 Ghana cedis. So you can go ahead and say unit contribution is equal to 27,000 minus 23,400, which is equal to, what's the value? Yes, Derek?
Yes, sir. What about the commission?
Good. Thank you. So commission is a variable cost. So variable cost per unit will be the cost of buying one car plus, let's go back to the question and be clear. In addition to their salaries, salespersons are paid a commission of 600 for each car they sell. So variable cost per unit of a car is the cost of the car plus the commission for selling one car. So that is correct, Derek. Thank you for reminding us. Variable cost per unit is this plus 600, giving us what?
24,000.
24,000. Thank you. Then unit contribution or contribution per unit is equal to the selling price per unit 27,000 minus the variable cost per unit 24,000, giving us what?
3,000.
3,000. Good. So it's very easy to do these simple computations. Then you slot them into the formula. Straight away you get your figures.
So you get 43.1.
If you have any question, please ask me. You are disturbing. So many people of you have your microphones on. Can you mute them for me, please? Okay. So now that we have every aspect of the formula calculated, we can slot them into the formula and get our figure, which is the break-even quantity. Break-even quantity is equal to total fixed cost divided by unit contribution. And it is equal to 129,200 divided by 3,000. What will this be?
43.06.
What?
0.06.
What 0.06?
43.1.
43.1.
Okay, so approximately we can't get a fraction of a car.
Yeah.
We wouldn't know what the fraction will be, whether it is the tire or it is the bonnet or it is the bumper. So approximately 43 cars, right? Approximately 43 cars. It means for Frankfurt Motors to be able to pay all of its costs, get zero profit, it needs to sell approximately 43 cars to be able to do that. So break-even quantity is, therefore, break-even quantity is 43 cars. And then we may be interested in knowing the revenue that goes with this 43. So break-even, you can say break-even revenue. And of course, if you are using these terms, you have to define them in your write-up. BER is equal to break-even revenue. So everybody understand what you are saying. It's equal to 43 cars. Each car is sold at 27,000. So break-even revenue is, Charles, I'll call you. Let's get this calculation. Break-even revenue, 43 times 27,000. What is the figure?
So please, it's 1,161.
Like this.
161,000. Okay.
Okay. 1,161,000. In other words, 1,161,000 Ghana cedis. So this is the revenue that Frankfurt Motors should generate to break even. And he can generate this revenue by selling 43 cars. That's great. Any questions?
Sir,
Yes, sir.
the CD sign is supposed to come before.
Yes, sir.
the figure
I
of-
missed the space. That's why I put it there. Thank you.
Okay, you're welcome.
It's supposed to come before. Okay, so that is it.
Sir, can I ask my question
Yes,
now?
sir, you can ask your question.
I had a little problem capturing the 23,400 as a variable cost.
Okay.
Because we are told that that is how much they buy the car for.
Yes, sir.
Is it that when they buy more cars, the price will be reduced?
No. When you buy one, let's say the cars are Toyota Corolla. When you buy
Yes.
one Toyota Corolla, what is your cost of
Yes.
sale?
That's 24,300.
Okay. When it is 23,400, good. When you buy
Yeah,
two of them, what would it be? 23,400 times 2, right? When you buy 3, what would it be? 23,400 times 3. So you realize that the cost of the car will increase
Yes,
as
sir.
you are buying more of the cars for sale. That makes it a
Yes,
variable
sir.
cost.
Okay, thank you.
In this case, you have to understand that we are not producing the cars. We are buying them and selling. So the buying cost is like our production cost. If we buy more of the cars, we incur more of the buying costs. And if you buy less, the cost also goes down like that. So it's a variable cost. So that is it for the break-even assessment.
So say.
Yes, madam.
Yes, please, I want to know, for example, the question, if a number of cars were given, let's say for instance 3 cars.
Yes.
We multiply the number of the variable costs.
Please come again.
Please, I am asking, for example, in a question, if a number of cars were given, for instance, maybe 3 cars, they were able to buy 3 cars.
Okay.
We multiply 3 with the variable costs.
That will not be too necessary because whatever the quantity of cars that are involved, you can use just one unit because all the cars have the same cost, they have the same selling price. The variable cost is also the same for every car. So you can do the analysis with only one car and then you multiply it by the total number of cars involved. It's just like what we are doing. We use a single car. One car is sold at this cost, 27,000. This is the variable cost associated with one car. And then we did the analysis to get the total number of cars that we have to sell. And it is 43, but we did the analysis with a single car. That's how we do the analysis. It becomes necessary to probably consider the number of cars involved if each of the car is coming with its own cost and its own variable cost. Its own selling price and other things. If that is the case, then it is maybe useful to look at the total numbers involved because each one is coming with its own information. But once all of them are the same, they have the same selling price, they have the same variable cost per unit, and the total cost is for all of them together. Do the analysis with a single one, and then you translate it to cover whatever quantity is involved.
Thank you, sir.
Okay. So this is break-even. Now let's look at if you want to get above zero profit. Remember, we are doing this on the assumption that there is no government to come and tax us. We hate operating in a government region, or we are in a tax-free zone, so there is no tax applicable. After the analysis, we'll look at where tax comes in. So break even. Now let's look at if we want to get some target profit. Let's go back to the same question. I think it has a question to help us do that. B. Okay, we have done the B. What is the total sales revenue that will be generated by Frankfurt at a break-even quantity? That's the 1,161,000. C. Frankfurt Motors has a target monthly net income. Okay, when I say net income, it means income after tax, but we have not considered tax yet. So let me rephrase that question and say, Frankfurt Motors has a target operating profit, right? Instead of the net profit, let's make it operating profit, so tax doesn't come in. Frankfurt Motors, because we have not considered the issue of tax, so I want us to look at issues without tax first. Frankfurt Motors has a target monthly operating profit, that is profit before tax, of 51,000. How many cars should he sell to be able to earn this target operating profit of 51,000? Are you okay with the question? I'm just introducing a question into it. So get the sense behind the question I'm trying to put across. Frankfurt Motors wants to get a target monthly operating profit before tax, of 51,000. So the company wants to get a target profit of target operating profit of 51,000 Ghana cedis. The analysis we have done so far, the first one, the company wanted to get a target operating profit of 0. And then we said to get that, you need to produce and sell. No, you need to sell. He doesn't produce it himself. Frankfurt Motors need to sell for the 3 cars. Now, Frankfurt Motors doesn't want to get a target profit of 0. He wants to get a target profit of 51,000 Ghana cedis. How much cars should he sell? Who can attempt? And if you get it right, I'll give you 2 marks.
Hey.
Yes, sir.
So I'm taking the 2 marks.
You are taking the 2
They have
marks.
to produce 60 cars.
Okay, so show us.
Hey,
I'm writing
60.
your solution.
They have to produce 60 cars. No, sorry, sell. They have to sell 60 cars.
You have to sell 60 cars. Okay. But show us
Yes,
your methodology. How did you get the 60 cars?
You know, already for the 43 cars that they had break even, the total fixed cost was 129. So the total fixed cost plus their targeted profits, which is 150, the 51,000, the 51,000. So 129,200 plus 51,000 divided by 3,000. So I don't know whether I've explained to you well.
Yeah, it's okay.
Okay.
It's okay, but
Hello, sir.
Okay, sorry. Then let me start from the beginning.
Okay.
We say that to targeted profit is equal to the targeted quantity to make profit.
Yes. Or the quantity to earn a target profit.
Yes, sir. Should be equal to total profit plus
the target profit.
Sorry, targeted profit plus total fixed cost divided by the contribution.
What contribution?
Which is
contribution per unit.
Contribution per unit, which is selling price per unit minus variable fixed cost per unit.
Good.
And we know from the first workings that our total fixed cost is 129,200. And we also know that our contribution per unit is 3,000. So the targeted profit coming in is just to add the 51,000 to the 129,200 and divide by the 3,000, which gives us approximately 60.
So what would the top be?
The
51,000
the
plus
total
129,200. I'm showing the formula, so if someone wants to make a note, or I'm also recording the lecture so you can follow it later. And be reminded that all the lectures we have done so far, I have uploaded the videos for you. So you can do a repeat lecture by watching the videos. So what would the top be?
The top will be 180,200.
180,200, like this.
Yes, sir.
Divided by 3,000. And it is approximately
Yes, sir.
60 cars, right?
Yes, sir.
Okay, so therefore, quantity to earn target profit of 51,000 is equal to 60 cars.
60 cars.
Yeah, great. Who has a
Sir, my
question?
2 marks. Oh.
So I think you have 2 marks. Who has a question about the solution?
Hello, sir.
Yes, madam.
Please, so where do you get 51,000?
That is the target profit. Now,
Is it in the question?
yes, we said the company. You see, the first one we solved, which was the
Yes,
break
sir.
even.
Yes.
It was as if the company is saying, I am targeting a profit of 0. So profit 0, then we know the formula. And I told you that no company wants to make profit 0. So now Frankfurt Motors is saying that he wants to get a target profit of 51,000. And then we said once that target profit of 51,000 comes in, you should know how the formula modifies for you to get a quantity to get that profit. Then the formula, when there is a target profit, is this. Now this target profit is not 0, so you put the value there, you put the 51,000 here. And every other thing is the same for the formula. The first one, the target profit was 0, so we put 0 here, and it was total fixed cost over unit contribution. Now the target profit is not 0, it is 51,000, so we put 51,000 here, and it will be 51,000 plus the total fixed cost divided by the unit contribution. Are you okay?
Yes, sir.
Thank you. Okay, so that is how we assess.
Hello, sir. Hello, sir.
Yes, sir. Yes, madam.
I'm a bit lost. I'm lost because there is a formula that I wrote.
Okay.
I think yes, and then I see it's a bit different from what is being done.
It's not different. Okay, what's that formula? Should I go back?
Let me just explain so that you quantity target profit is equal to target profit plus total fixed cost over selling price per unit minus
variable cost per unit.
Okay, but then I see that it's now total is target profit plus total fixed cost over contribution per unit. So I really don't know.
So what is it that you don't know? Be specific about that one. Your problem. What is the confusion?
I'm saying that it was target profit plus total fixed cost over selling price per unit minus variable cost per unit. Now I see it's been replaced. The selling price per unit minus variable cost per unit has been replaced with contribution per unit.
Who can help her for me?
Sir, I can do that.
Okay, please help her for me.
Auntie Kate,
Yes.
the selling price per unit minus the variable cost per unit is the same as contribution per unit.
That is the name of that formula. Contribution per unit is equal to selling price per unit minus variable cost per unit. You remember, Auntie Kate, when we were taking ourselves back a little, trying to look at marginal costing principles, we said that sales revenue minus variable cost is called contribution. At the unit level, selling price per unit or sales revenue per unit minus variable cost per unit is called contribution per unit. And in the course of the lecture today, I have specifically said it. Maybe your mind was not there.
No, my network keeps going and coming, so it's like I missed it.
So if you look at, that's why I have brought you back here. This is the first formula we derived, the one in black, right?
Okay.
Profit. The profit can be any profit. It can be zero profit. It can be a profit above zero, plus total fixed cost all over selling price per unit minus variable cost per unit. This is the generic form of the formula. Then I told you that the one below, I circled with red box. This one below is called contribution. And because we are calculating the data at the unit level, it's called contribution per unit or unit contribution. So you see, I came to write here contribution per unit as a replacement or synonymous to this. So we have to be following the lecture.
Okay, sir. Thank you.
Okay, so this is great. Everybody understands it. Now let's look at where the government comes in. So the issue of tax. Government is coming in. So it will modify the formula a little bit. Let me try to make it very simple. When the government comes in, whatever profit we want will be called profit after tax. So let's say PAT, profit after tax. Profit after tax is equal to profit before tax minus profit before tax times tax rate. Let's make it this, tax rate. Do you understand this formula?
No, please.
Okay, let me use figures, we will understand. Let's say we have made an operating profit, that is profit before tax, of 1,000. Government taxes our profit at 10%. So tax rate is equal to 10%. How much tax would we pay to the government?
100.
And show by formula. We have made government taxes on our profit. We have made a profit of 1,000. Government takes 10% of that profit. How much tax would we then pay to the government?
100.
100.
Is equal to what?
100, sir.
100. Okay, so
yes.
tax amount to pay to government will be 1,000 times 10%, right?
Yes, sir.
Is equal to 100. This 1,000. This 1,000 is this. And this tax rate is this. To give you this 100, this is the tax amount. So if you want to get the profit that will be remaining after paying the tax, it is when you subtract this 100 from 1,000, isn't it?
Yes.
Yes, then you get 900. So when you subtract the whole of this from this is the 1,000 profit before our tax. And then to get the tax amount we have to pay to the government, we multiply the tax rate by the profit before tax to get a tax amount of 100. Then to get our profit after tax, we take the tax amount, which is profits before tax times the tax rate, from the profit before tax, then we get our tax profit after tax. Are you okay?
Hello, sir.
Are you okay?
Hello, sir.
Yes, madam.
Sir, please, can you please go over this one for me?
Yes, I'll go over it for you.
Okay, thank you.
Profit before tax. This is the profit the company has made before the government come and look at it and say, okay, I'm going to take this percentage from your profit. Then when the government takes its tax from the profits we have made, we get profit after tax. Is that correct? Is that
okay, sir?
Okay. Let's say the profits that we have made before the government came in, profit before tax, was 1,000. Now the government taxes us at 10%. So tax rate is equal to 10%. Then the tax that we will pay to the government is 10% times the profit we have made. So this is the tax amount. And this will be equal to 100. This is equal to 100. Then when we subtract this 100 that we are paying to the government from the profits we made, then we get to know the profits that we are paying, that is remaining, profit after tax, 900. So when we want to write a formula for all of these things, we are saying that this profit after tax is equal to this profit before tax first, minus, remember that the tax amount of 100 was computed as the profit before tax times the tax rate, 10% times 1,000. This is our profit before tax, and this is the tax rate. It's equal to 900. So if you see profit after tax, profit after tax is equal to profit before tax minus profit before tax times tax rate. This is the one I wrote first. This can be written as P part is equal to profit before tax minus profit before tax times tax rate. Are you okay now?
Yes, sir.
Okay.
Thank you so much.
And let's look at something. We have this year, just like I did for the first formula when I was trying to derive the break-even assessment. We have PBT here, PBT here. So PBT is common to the two terms. We can bring PBT out and say 1 minus tax rate. This is basic mathematics, so all of us went to GHS and SHS. So I am not reinventing the wheel. I am just reminding you of the things you learned so many years ago. When you expand this, you will get the same thing here. So it is this that I have reduced or rewritten in this form. When you multiply PBT by 1, you will get PBT minus PBT times TR, you get PBT times TR. So you should be okay. We have not changed anything. So if we also want to express PBT in terms of PAT, we can also have this formula. PBT is equal to PAT divided by 1 minus TR. Let me explain why it is like this, because some of us are very weak in mathematics. If we want to make PBT the subject, it means we have to divide here by 1 minus TR and also here by 1 minus TR. This one cancels this one out. Then we will get a formula like profit after tax divided by 1 minus TR is equal to PBT, or PBT is equal to PAT 1 minus TR. Is the same. Do you understand this mathematics? Understandable?
So go over again.
Understood? Matthias here.
So go over again for us, please. Please go over again.
I should
please.
go over.
Yes, sir.
Yeah. Yes, sir.
Okay. This is what I'm trying to say. All of us understand this. This one I have gone over, we have understood it. Profit after tax is equal to profit before tax minus profit before tax times tax rate. I only want to make profit before tax the subject. We also said that this can be written as profit after tax is equal to profit before tax out 1 minus tax rate. I am rewriting this formula as this. And let me explain the reason why I made the PBT the subject, to give us those formulas you said I should go over again. When we already have the formula for calculating the break-even quantity when the company wants to make some target profit before tax, target operating profit. That formula is there. We still want to use the same form of that formula. We want to use the same form of that formula. So what in effect we want to do is that if the profit, the question tells us, is not operating profit, it's not profit before tax, we want to convert that profit after tax to its profit before tax equivalent. Then we use the same formula. In other words, if the question says Frankfurt Motors want to earn profit after tax of 51,000, profit after tax, we understand that if profit after tax is 51,000, then profit before tax has to be more than 51,000. Is that correct? Hello, yes. I want you to participate in the discussion. Hello? Do you understand what I said?
Yes, that is correct.
Yes. The question can say the company wants to get after tax profit of this much, let's say 50,000. We do not want to complicate the formula with the tax rate, blah, 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 to be so cumbersome. We are already comfortable with if the company is making a target profit before tax. We add the profit before tax to the fixed cost and divide it by unit contribution. We do not want to alter that formula. So what we are seeking to do is that if the question has given us after tax profit, we have to convert it to before tax profit. And we have not changed it, it's the same. We are just using its equivalent before tax profit. Then we slot it into that formula we know already, and then we get the same thing. So this is the formula that helps you to convert profits after tax to profit before tax. That is why we were making the profit, we are expressing the profit before tax here in terms of the profit after tax. In other words, that is a formula that converts profit after tax to profit before tax. So if you make PBT the subject, which is by dividing here by 1 minus TR, this takes this one off. Also here by 1 minus TR, then we get profit before tax to be equal to profit after tax divided by 1 minus TR. What it means is that if the question has given you profit after tax, then if you divide the profit after tax by 1 minus the tax rate, you convert the profit after tax to profit before tax. So let's use the example we were using to clarify. Sometimes example help to clarify these things better. Let's say the company wants to earn a target after tax profit of 900. All right. The company wants to earn targeted after tax profit of 900. Government taxes us at 10%. We do not want to use the 10% and the 900 straight into the formula. So we want to convert this 900 after tax profit into its profit before tax equivalent. Then we use its profit before tax equivalent instead of using this one and this. So if we want to earn after tax profit of 900, it means that our profit before tax should be bigger than this. But what is that figure? That's what we are trying to do. And this is the formula. Profit before tax is equal to this profit after tax 900 divided by 1 minus 0.1. 10% is 0.1. So we get profit before tax to be equal to 900 divided by 1 minus 0.1 is what? You can participate. Put your microphones on.
0.9.
It's 0.9, right?
Yes, sir.
900 divided by 0.9 is equal to what?
1,000.
1,000.
1,000. So remember, I used this same example when I was trying to explain to you the first thing. You now know that the first example I gave you, the company had made profit before tax of 1,000. Then it is paying tax rate at 10%, then we calculated it as 100. And then we subtracted the 100 from the 1,000 to get the profit after tax of 900. We are trying to work backward. So if we have the profit after tax of 900, and then we are paying tax at 10%, it means our profit before tax should be 1,000. And this is the formula that will help you to convert the profit after tax to profit before tax equivalent. So now that you have converted the profit after tax 900 that the question gave you into its profit before tax equivalent of 1,000, now the formula becomes quantity to earn profit after tax of 900 is equal to 1000 plus 192,200 divided by 3000. Are you okay? This one is the converted part into. Are you okay? Hey, you are not minding me.
We are trying to absorb. Yeah, on.
Please, this one, if you go home and you...
The absorption rate is low. That is why.
Hello.
We are trying to.
Sometimes, you know what? I'll advise that you do it this way. I can gauge that you understand it 50% or 50% plus. That is fine. If you go home, don't go and close your book. Find something to eat. And then even as you are going home, try to be thinking about it. Sometimes when you do that thinking exercise, as you are thinking, then you begin to realize that, okay. You go and you confirm, okay, now you have gotten it. It's not difficult. You have profit after tax. Take it like this. The formula that is available for us to use, we cannot use the profit after tax straight. We have to convert the profit after tax to profit before tax.
Hello, sir.
Yes, madam.
Please, what have you written?
Hello.
Sir, after the solution, you've written something here. I'm not getting it. What is this?
I said...
what is it?
I said this 1,000 we have put here.
Yes, sir.
You know, the question said the company wanted to get after-tax profit of 900. But we have not put 900 here. We have put 1,000 here.
Yes, sir.
This 1,000 is the converted part of 900 to PBT. So we have not really changed the 900.
Okay.
It's just like, you know, in mathematics, we can express one thing in a different term, but they mean the same thing.
Yes, sir.
For example, if I write 1 times 3, I can write this same thing as 3 times 1.
3 times 1.
Okay. So we have not changed the resource. We are only changing the different forms that it can be written.
Okay.
So writing part of 900 is the same as writing PBT of 1,000. So we are not comfortable working with this straight away because of this tax rate and how we do the iteration. So we convert this part to 1,000 at a tax rate of 10%, and that takes us to, we convert this 900 to profit before tax at 10% tax rate, and that takes us to 1,000, and then we use the 1,000. So I wrote here this 1,000 is converted part profit after tax into profit before tax equivalent. Are you okay? Are you okay, my people?
Okay, yes, sir.
Okay. So that is how, if there is tax involved and a company wants to get a certain amount of after-tax profit, that is how you do it. Convert the after-tax profit to before-tax profit. They are the same. You have just converted it from one form to another. It's just like converting 0.1 to percentage. 10% is the same as 0.1. 100% is the same as 1. That's how they relate. Converting fraction to percentage. So converting after tax profit to profit before tax, you know the formula. The formula is the profit after tax divided by 1 minus the tax rate. You convert it to the profit before tax. And then you use the profit before tax figure into the formula, and it is great. So now let's go back to our Frankfurt Motors question. Okay, so like I was telling you, there are some typing mistakes here. So some of these figures, you have to use your pen to correct them. There were some typing mistakes here. The C part. Let's go back to the C part again. Frankfurt Motors has a target monthly net income. Net income is profit after tax of 51,000. That's the target. Make profit after tax of 51,000. Then the question wants you to know something. What is its monthly? What is its target monthly operating income? In other words, convert the after-tax profit of 51,000 to profit before tax. What would that be? Now we know the formula. Everybody should try his hands. The company's target after-tax profit is 51,000 cedis. What is its profit before tax? Tax rate is 25%. I think that was it in the question. Yeah, tax rate is 25%.
Jason.
So let's try it. Let's do it. Who has finished it? I'll give 2 marks if it is correct.
Jason. Hurry up and bring my calculator.
Hey, no.
Yeah.
Yeah?
One every JJ.
Sir.
Okay, Mauli.
Yeah. That's 68,000 Ghana.
So show it in formula. Let's see the procedure.
68.
Profit before tax is profit after tax divided by 1 minus tax rate, right?
Yes, sir.
So profit before tax is equal to
51,000
1,000
divided by 1 minus 0.25. Profit before tax is equal to 51,000 divided by 0.75. And that is equal to
68,000.
68,000. It means that if the company wants to get after tax profit of 51,000, it has to make a before tax profit of 68,000 because government is going to take 25% of it. That's it. Then the deep part of the question is saying that it broke it down. So it's saying that how many cars must be sold each month to reach the target monthly net income? Now the first part of the question has forced you to convert the parts into PBT. And it's now asking you that now calculate the quantity that should be sold to get that after tax profit. So instead of using the after tax profit of 51,000, you use the equivalent before tax profit of 68,000. So we work it like this. Quantity to earn target profit of, quantity to earn profit after tax of 51,000 is equal to 68 divided by 68,000 plus 129, 200 divided by 3,000. The top part will be how much?
Sir, 197,200.
197,200 divided by 3,000. So what would the total figure be? Hey, who is writing on my wall?
Sir, 65.73.
Oh, who is annotating my wall?
Oh.
Please don't do that. It's not your screen. Don't write on my screen. It will be what?
65.7.
65.7 will be approximately 66. So it means that Frankfurt Motors, to be able to earn after tax profit of 51,000 Ghana cedis, he has to sell 66 cars. Let's compare. When we calculated the first one, the quantity Frankfurt Motors should sell if he wants to get a before tax profit of 51,000. It was the same amount, 51,000. Just that this second one is after tax profit. When it was target profit before tax of 51,000, the quantity of cars that Frankfurt Motors had to sell was, if I remember, I think it was
60.
It was 60.
60, yes, sir.
It was 60 cars. So it should tell you that if the now government is taking some of the money to make the same 51,000, you have to sell more cars. And that is how come he has to sell 66 cars. Yeah, so the analysis makes sense. Okay, so this is what we have so far. Any questions? Any questions? So please do the corrections in the textbook. There were a few mistypings that generated wrong answers. So do the corrections for me. That is why it is important, in addition to having the book, to come to class.
Is it a cost accounting book? Which page?
Hello, sir.
Yes, madam.
Please, is it the cost accounting book?
Yes, madam.
Please, which page?
Chapter 10. Chapter 10. I don't have the book with me right now, so I don't know the exact page, but it will be part of the initial pages in chapter 10.
Okay.
You will see, when you open chapter 10, you will see when you go to example section, example 1, you will see the Frankfurt Motors example. Then the solution.
Okay,
And try to make the
you.
changes there.
It's page 153. Page 153.
Yeah, page 153, good. So please make the changes there before you forget.
Yes, sir.
Okay, thank you.
Okay, so if you don't have any questions, I want to give ourselves like 5 minutes break. The 5 minutes break, please use it to discuss few things among yourselves that you think you need to discuss. Then just in 5 minutes time, I'll be back, and then we continue to, we will conclude on the single product today. Then we complete everything. So just 5 minutes. My time says 8:25, so I'll come back 8:30, and then we do the remaining 1 hour. Okay, welcome back. Now let's look at if we want to get the revenue involved in all the calculations we have gotten straight away. Remember that for now we are calculating the quantity of the products. So quantity of cars to sell to make a target profit of 51,000. Quantity of cars to sell to break even. In addition to the quantities, we also need the monies involved. For now, we have learned that we can get the monies involved by multiplying the quantities by the selling price per unit. But there's also a formula that makes you get the sales revenue figures straightforward without multiplying the quantity by the selling price. And this new set of formulas we are coming to learn is also useful when we are doing multiple product environments. So you have to take your time to understand. So that formula uses the concept of contribution to sales ratio. Contribution to sales ratio, written in short as CS ratio. In American textbooks, you will see the same thing I have written here. Please take your time and listen to me before you bring me back. You will see the same thing I've written here, contributing to sales ratio or CS ratio, written as contribution margin ratio, shortened as CMR. They are synonymous, they are the same. It depends on whether the text is coming from American or is coming from British. Contribution to sales ratio or contribution margin ratio is equal to contribution divided by sales. So if you are using per unit data, it will be unit contribution divided by selling price per unit. That's the formula for contribution to sales ratio or contribution margin ratio. So the Frankfurt Motors example we were using, the contribution was 3,000. And the selling price per unit was 24,000. Contribution to sales ratio will be, or contribution margin ratio will be, calculate and tell me.
The selling price was
27,000.
27,000. Good. Selling price was 27,000. Good. So contribution to sales ratio will be Yes, I'm listening to you for the figure.
0.111111.
0.111111.
Yes, sir.
Okay. So you can make that figure be on your calculator. If I round, it means we will not get the exact figure. I want to confirm something. So 0.111111, whatever. To get the or to get the sales revenue. To get the sales revenue, so let me say sales revenue. To get the sales revenue to generate, let's say, profit 0. When we use the other formula, I think we had 1,161,000 something. So sales revenue to break even using the contribution ratio formula. Contribution to sales ratio formula is equal to the total fixed cost. Hello. Yes, I'm in Pachometra. You, my office over to me about. To get the sales revenue at break even without multiplying the break even quantity by the selling price, using this concept of contribution to sales ratio, the formula will be total fixed cost divided by contribution to sales ratio or contribution margin ratio, which will be 129,200 divided by 0.1111. So do this on your calculator. Just do 129,200 divided by answer. You should get the same thing as what we got. If we round the figures, it will be approximate. It will be short somehow. So do it and confirm for me.
Hello, sir.
Yes, madam.
Yes, I had 1,162,800.
Did you use all the figures?
Yes.
Okay, it's very possible. We have to remember that the 43 cars were rounded figure. It was 43 point something, right?
Yes.
And then I said that we can have a fraction of a car. Okay, so these things will cause the variations. If you want to confirm that it is exactly the same thing, use the 43 points, use all the figures, 43 point something, and multiply it by 27,000. Put the figure there. Let's do that exercise. What would it have been? 43 point what? It was 43 point something, but we said we should round it to 43.
Yeah,
Hello, I can't hear you. Let me hear you. 43.06. 43.06.
Yes.
Okay, that's all right. So 43.06 cars. Let's multiply this by 27,000. That's the selling price for one car. What will that be?
1,288.
Your camera is very bad. Let another person talk.
1,162. 1,162,000.
Read them as individual figures. 1,
comma
1,
62, comma 620.
like this.
Yes, sir.
Okay, good. So this is the full figure. Now we want to compare this. So let's do the same thing.
Sir.
129,200 divided by the full fraction.
Hello, sir.
Hello?
Yes. If you divide 1,200 by 3,000, you get 43.0667. And if you multiply by 27,000, you get 116,800.
116,800.
Yes. So when you divide 129,200 by 0.11, you get 116,800, as they say.
Are they the same?
Yes, please.
Yes, sir.
Yeah, so that is the meaning. What I want to emphasize is that you can use this concept I am teaching you right now, the concept of contribution to sales ratio.
Sir.
Yes, madam. Does anyone have a question? I heard my name. Okay, let me continue. The concept of contribution to sales ratio, which is given by the formula contribution divided by sales, or contribution per unit divided by selling price per unit. If you divide the total fixed cost by the contribution to sales ratio, then you get the sales revenue to break even. In the same vein, if we want sales revenue that will give us a certain target profit, then the formula is the target profit plus total fixed costs divided by contribution to sales ratio. Then it gives us the revenue straight away. Is that correct? Is it clear?
Yes, sir.
Thank you very much.
Yes, sir.
Okay. So what is left for us to conclude on the single product environment is to talk about something called margin of safety. Margin of safety. I want you to go to your book, the page that you can find this. I skipped all the preliminary pages, those ones that have to do with the theories and other things. So something like, let me go back and tell you something. As for all of these things, an introduction is your job to read. So, assumptions under which this CVP analysis is done, you have to read and understand them. So this is for you. They are all here. Advantages of CVP analysis, limitations, all of them are for your reading. The various methods, that's what I'm telling you. The equation method, you can do everything using the equation, or the contribution margin method, that is reducing the equation to get the formulas that we are doing. We will talk about graph later. What I want to read from the book is on the margin of safety. I want to read as a test, so you can follow me from your book. Margin of safety, written in short as MOS, is the extent that sales must decrease before losses are recorded. I will explain. It specifies the extent of vulnerability of profit to changes in sales. In other words, it is the region that is safe for an organization to operate. Within that region, fixed cost has been covered, therefore all production will lead to profit. It is determined as the difference between expected or the budgeted sales and the break-even sales. Margin of safety can be expressed as an absolute value or as a percentage of budgeted sales or actual sales. This is what we are trying to gauge with the margin of safety. You know, we have the break-even point, right? The break-even point is as if on a number line. Let me draw something like that to illustrate. On a number line, this is the origin, 0. All of this part, I think this is negative region, and this is positive region. Ideally, in terms of profits, and in terms of profits and revenues, every company wants to operate in the positive regions, this side. But your break-even point is making you be on the 0. You are neither in the positive nor negative. If something slightly negative happens to you, you will go into the negative region. This is like death region. Because if you continue to make losses, your company will die. And this is like life region. You always want to be in life. Here you are the borderline between death and life. If you are able to push a little here, you are getting safer and safer and safer and safer. Yes, sir.
Please, can you tell them to mute their mics?
Please mute your mics. Bendakun Alan D. Alan. Alan, what's your surname? I think you entered one of my classes wrongly. You entered my auditing class. I saw your name there.
Oh, sorry. Dudima.
And it's not only Alan. A number of you have wrongly entered a different class. When you enter a wrong class, you yourself should know that you are an alien in that class. Everything there is not for you.
Yes, sir. So we saw it, but that was when we were trying to register for the Google class.
Okay.
So that is where the problem came from.
Okay, so maybe you cannot take yourself away from the class. I'll go and take you away from that class.
Okay, thank you very much, sir.
So I'm explaining the margin of safety. Take the cues from the words safety. And I'm using this to explain. On the break-even line, on the break-even point where you are making zero profits, it's like you're on the borderline between life and death. If you're able to get rightward from the origin line, you are getting safer, you are getting more into the region of life. In fact, if your life is heading towards here, you are getting into danger. So, if this is the break-even quantity sold, we will be more safer if we move from here into here and here and here and here. Any quantity away from the origin is making us more safer. So we gauge our safety by how much our sales are away rightward from the origin. We gauge our safety by how much our sales quantity, our sales line or our sales revenue is away from the origin rightward. So it is simply your sales minus your break-even sales. Break-even sales, that is your margin of safety. This gives you the absolute figure. You can convert it to 100% by doing this sales minus break-even quantity divided by sales times 100%. So this becomes the target sales. If it is an actual figures they have given you, then it's the actual sales minus the actual break-even. But most of these analyses are done on budgeted basis. We do this assessment to appraise the company. I mean, to kind of look at the company in terms of forecasts, to get a sense of whether the company will be viable, how much it will take us to sell to break even, how much it will take us to sell to get this profit before we roll the business out. So most of the questions may be done on budgeted or forecast basis. That does not mean that you cannot get a question that you are dealing with actual figures. But whatever it is either the target, the budget sales or the actual sales minus the actual break-even quantity or the budgeted break-even quantity. That is your margin of safety in absolute terms. If you want to convert it to quantity, this percentage, this becomes what it is. So you can use the quantity. So this is sales quantity, budgeted or actual, minus the break-even quantity, budgeted or actual. You can also use the revenues involved, but you have to do like with like. Like begets like. So if you are using quantity, you don't mix it with revenue. If you are using revenue, you don't mix it with quantity. That's the only thing about it. So let me see. So this is the formula from your book. You can read through it. Okay, so all the formulas are here in your textbook. All the formulas that we derived, they are beautifully here. I wanted to see if I can get a question that has margin of safety. So for this Franco Motors question, if the question had added information about the target sales of the company, let's say the target sales of the company is let's say 50 cars, then the calculation of the margin of safety is that target sales minus the target break-even sales. So 50 cars minus 43 cars, that gives you 7 cars. So in absolute terms, our margin of safety is 7 cars. In terms of percentage, it will be 7 divided by 50. So you are expressing it as a percentage of the target sales. 7 divided by 50 times 100%. Then you get the margin of safety in terms of percentage. So margin of safety calculation is not difficult. It's a small piece of calculation. So go through that and you'll be fine. So that is it for the single product environment. A single product environment. Any questions so far? Any questions?
Sir.
Yes, sir.
Sir, please, with the margin of safety, can you please go over it again?
Yes. I'm saying that margin of safety means safety. You are calculating how safe you are. And I use this thing to explain. This is the break-even. When you are operating at the break-even point, you are just selling the quantity to pay all your costs. There is no profit yet. It doesn't mean you are dead. You are still in life. But the slightest mistake, you go into the death region. All right? If your sales drop a little bit, you will now go below the break-even to enter into negative profit. Now you are having 0 profit. If things go worse slightly, you will get negative. Negative is death. So you calculate how safe you are by looking at how your sales figure compare with your break-even. So if your sales figure is lower than your break-even, it means you are dead. It means your margin of safety is very bad.
Okay.
And you get a margin of safety to be negative. If your sales is bigger than the break-even, it means your margin of safety is positive. And if the figure involved, if it is the bigness is quite substantial, then it means you are more safer. So to measure your safety or your safeness, subtract the sales you are making, subtract your break-even sales from the sales you are making. That gives you a measure of how far you are from the borderline. So that's how we calculate the margin of safety. Sales minus break-even quantity. So sales quantity minus break-even quantity. Then you get the break-even in absolute terms. So if your sales was, let's say, 43 cars. So no, if your sales was or if your sales is budgeted to be 50 cars, and then your budgeted break-even quantity is 43, then your margin of safety is 7 cars in absolute terms. And I also said you can calculate your margin of safety in percentage. In that case, it is your sales of 50 minus the break-even quantity sales of break-even quantity of 43 divided by 50 times 100%, which will be 7 over 50 times 100%. This will give us what? What is the percentage for this? 7 over 50 times 100?
14.
14%.
14%.
Yes.
Yes, sir.
It means that...
Yeah, 14%.
14%, good. For the first one, it means that our sales should fall by 7 cars before we begin to be in the danger zone. It means we are 7 cars away from the danger zone. That's the measure. You can say the same thing, that sales should drop by 7 cars before we begin to incur losses. If you put it in percentage like this, you will say that sales needs to fall by 14% before we begin to incur losses. That's the meaning. And I also said that this one we are using the quantity of cars. You can also use the revenues involved. So the target sales revenue, which equivalent to the 50 cars, and then the sales revenue equivalent to the 43 break-even quantity. If you are using sales revenue figures, it should be sales revenue figures all out. So here, the sales revenue would have generated the sales revenue equivalent to 7 cars. But the percentage would have been the same. The percentage will be the same 14%, whether you are using revenues or you are using quantities. Is that true? Is that correct? I hope that is okay. Multiple product environment. Let's try to introduce it. The multiple product environment, I'll give you separate notes. It's not in the textbook. So I'll do a very simple note and make you have it through the platforms. The multiple product environment, the key assumption, it operates on a very key assumption. The assumption that the various products we sell, they are sold in some constant mix. So it behaves like the products are bagged, they are packaged, and then they are sold as packages. So if the Frankfurt Motors are also selling, let's say, refrigerators and air conditioners, then it's like every one car is packaged with, let's say, 2 refrigerators and 3 air conditioners. That is the assumption. Sales are made in some constant mix. That's the only assumption that will make us be able to do the analysis. Even though it doesn't make so much sense, in practice, what we do is around something like that. Even if you don't have it as a policy, every one car, as if a person is going to buy a car, by force, he should buy refrigerators and air conditioners. It doesn't make sense for it to work that way. But what we do is that within a given period, you can gather information on the cars you have sold, the refrigerators you have sold, the air conditioners you have sold. You can get a ratio between them. you can do a calculation and see, okay, for every one car sold, 2 refrigerators were sold. You can do that calculation and know. Yeah. So on that assumption, then we proceed with the analysis. So I want you to go and read on the multiple product environment. You can Google, you can watch YouTube videos, but read around this, what is called weighted average contribution. Weighted average contribution margin ratio, or weighted average contribution to sales ratio. These are the key things we will need in those analysis. So we'll break the class here. Go and read on the multiple product environment. Your reading should mainly focus on the concept of weighted average contribution to sales ratio, or weighted average contribution margin ratio. Okay. So this is where we'll end the class. If you have questions for me, I'm ready for them now. Questions? The multiple products analysis will be done in just about 30 minutes. Hello? Yes, but I'm in class. I'm from a few minutes there. The multiple product environment maximum should take us 30 minutes to complete. Then we will follow it up with budgeting. So in terms of reading, you can begin to read budgeting. Budgeting is in your textbook, but I don't have it right here, so I don't know the page and the chapter. When you look at the content, you will see where it is, so you can begin to read. If there are no questions, this is where we end the lecture. Thank you very much.
You're welcome, sir.
Thank you, sir.
Thank you, sir.